Well, we are moments away from learning what the Federal Reserve will do with its second interest rate decision of the year. Again, second time this year, first time since some of the president's tariffs took effect. The Federal Reserve will be making this decision, although economists largely expect they will be leaving benchmark interest rates unchanged. And remember, this is all in an effort to get that inflation rate to the benchmark 2%. Right now, is what I'm seeing here the results? Control room? Do we have? Okay. So this is expectations of what the benchmark would be unchanged to 4.25% to 4.5%. I want to go ahead. Can you guys repeat, please? Okay. There we have it. So this is all happening in real time in the 2 o'clock Eastern hour. Interest rates unchanged and will remain steady, in line with predictions. CBS News business analyst Jill Schlesinger joins us now on set. I also want to bring in CBS News contributor JD Durkin for more on all of this. So Jill, sometimes it's not exactly to the second. It can get a little messy, but we got the answer there. And so why unchanged?
Completely no surprise, by the way, well telegraphed. Just recently, Jerome Powell, the federal...
2 weeks ago.
Yeah, Jerome Powell just said, we can afford to be patient. And I think that you have to remember what the Fed's job is. It's to keep in balance two sometimes opposing forces in the economy. One is the Fed is trying to contain inflation, right now get that inflation rate down. But the other is to make sure that the economy is growing enough so that we see job creation. And when you hear the Fed say, no change, we can afford to be patient, I think this is that extra uncertainty around what's the tariff situation going to mean for the economy. Could it push up prices? Could it slow down economic growth? For now, there's no evidence yet, and that is why the Fed can say, hey, we're just going to wait until we have more clarity on what the next few months holds.
I had said 2% inflation benchmark. Fact check me on that. Is that correct? And also, where are we right now?
So right now we're at somewhere between 2.8 to 3% annualized inflation. Yes, the Fed would like it to get it down to 2%. But to be clear, gang, this is sort of a made-up benchmark anyway, that target. They say it's aspirational. It was at 2% for many, many years. But it is almost as if it came out of thin air. It is not grounded in any economic theory. It's grounded on the ideas at that level. We think those two things, price stability and a labor market that is solid enough to create jobs, we think that's the level, 2%, that brings that into harmony. But sometimes it doesn't work out that way.
Not exact science. All right, stay with us because I want to bring in JD. JD, how were markets responding prior to this and sort of the anticipation of the decision, and any knee-jerk reactions just in the last couple of minutes since the decision dropped?
No big knee-jerk reaction as of yet. I think it always takes a bit of time for the dust to settle, and we can't forget it's not just the interest rate decision that Jill was so expertly breaking down, but we also get today what's called the dot plot. It's a kind of a nerdy summary of economic projections, though, as Jill certainly knows, oftentimes the Fed is incorrect with their forward-looking guidance. They give us their best anonymous sense on where GDP is going to wind up, where is inflation going to wind up, where do they think the unemployment figure is going to go between now and the end of the year. The markets have been up throughout the day. The S&P 500 has been about up 0.5% or so. But Lindsay, of course, this is on the backdrop of a very volatile market. If the market does finish up today, the short-term good news is it would be the third of the last 4 days that the market has been in the green. But of course, this time last week, the big conversation was the S&P 500 officially hitting what's called correction territory, which means down 10% from its recent highs, and very recent highs at that. I mean, the all-time high for the stock market was all the way back on February 19th. That shows you just how volatile this market has been. And so it's always a few knee-jerk reactions. We get what happens after 2 o'clock, and then that's why we pay very close attention to what Jerome Powell has to say at the press conference at 2:30. He is off book. He is off script. That's when reporters get to push him for details on everything ranging from GDP to tariff policy. And you usually look to see the markets move a little bit when Chairman Powell takes the podium around 2:30.
So, Jill, let's talk about that. 2:30. What do you think he'll be telegraphing there? What will you be listening for?
Listen, I think that all of our colleagues who are down there, including Kelly O'Grady, they're going to be peppering the Fed chair with questions about what would get you to move. When do you think it's more important that we worry more about inflation than about the job market? They're going to ask, under what conditions would you actually cut? Would you ever consider raising rates in this environment? And, you know, Jerome Powell is quite skillful now that he's had this job for a few years. And I don't think he projects anything other than what he would like to project. And to be clear, what he has told us over the last few meetings and in many different conferences that he's spoken at is the economy is growing. It has slowed down here in this first quarter. We do not see a recession imminently, but we are watchful. And that's it. That is kind of what they're supposed to do. They're supposed to take in this information. As JD said, they are not perfect predictors. Nobody is. And we have to remember that. So for everyone who's at home, you look at this decision, you say, what do I take away? Well, if I'm a borrower, it's still going to cost a lot to borrow money because interest rates are still pretty high. If I'm a saver, I'm psyched because I'm still getting credited decent interest in my savings, my credit union accounts, my money market accounts. But if you're an investor, tune out the noise, gang. You're a long-term investor. You don't need to worry about this day to day.
Okay, Jill Schlesinger, JD Durkin, thank you both so much.